Welcome to the first week of AC 122. This week we will move on to some introductory materials to give you an overview of AC 122. The first thing that we are going to cover is the objective of accounting. The primary objective of accounting is to provide information that is useful in making good decisions. Imagine you have a lemonade stand. You spend money on lemons, sugar, and cups. You earn money by selling lemonade. At the end of the day, you want to know, first, did I make a profit or a loss? Second, should I buy more lemons tomorrow? And finally, is the stand worth continuing? So, accounting gives you these answers by keeping track of what you spend and what you earn so you can make smart decisions. Accounting may sound complicated, but really it's just a process of 3 simple steps. First, answering the question of what happened with money, then write it down with numbers. Tell the story with numbers and reports. Step 1 is often called identifying. Businesses first look at the important events involving money, for example, Apple selling an iPhone or Ticketmaster collecting money for a ticket. If we think about a lemonade stand, this is like noticing when you sell a cup of lemonade or when you buy lemons and sugar. Step 2 is recording. Once you know what happened, you write it down. You measure it in numbers and keep a record. At Apple, they might log sold an iPhone for $999. At our lemonade stand, it could be sold 10 cups for $10. Step 3 is communicating. Finally, all this information is put into reports so that other people can understand. Businesses prepare charts, financial statements, or summaries. At the lemonade stand, you might tell your parents, I made $6 profit today. That report communicates how well your business is doing. Now, let's see why we study accounting. Accounting is often called the language of business. Imagine trying to play a sport without knowing the rules. You'd be confused. You wouldn't know if you were winning or losing. That's exactly what it's like to run a business without understanding accounting. You might be selling a lot, but without tracking your costs and profits, you don't really know the score. But accounting is not just for big businesses, it's useful in our personal lives too. It helps us create a budget so we don't overspend, plan for retirement or college, compare whether leasing or buying is smarter, and evaluate loans or investments. So, in short, accounting is the tool that helps us make smarter decisions with money, whether in business or in our everyday lives. Whenever a business prepares accounting information, we should ask who uses it? And the answer is 2 main groups, external users and internal users. First, external users. These are people outside the business who still need to know how it's doing. Think about investors deciding whether to buy shares, banks deciding whether to give a loan, or government agencies checking taxes. They don't run the company, but they need reliable financial information before making decisions. It's like looking at a scoreboard before betting on a team. You want to know if the team is winning or losing. Second, internal users. These are the managers and employees inside the business who use accounting to plan and make decisions. For example, they use budgets to decide how much to spend, performance reports to see if goals are being met, and financial data to set future strategies. They're like coaches and players who study game statistics to improve their performance. We have different careers in accounting, so at this moment, I encourage you to pause and look up those ones that look interesting to you. Accounting isn't just one job, it comes in many flavors, depending on who you help and what problem you solve. Let's look at the main types. First, tax accountants. They help people and businesses play by the tax rules, making sure taxes are filed correctly and no one gets in trouble with the tax authorities. Second, financial accountants. They're like scorekeepers. Their job is to record, track, and report financial transactions so everyone knows the true financial position of a business. Third, managerial accountants. These are the behind the scenes advisors. They collect and analyze data to help managers make better decisions, cut costs, and plan future strategies. Fourth, forensic accountants. Think of them as detectives. They investigate financial records to uncover fraud or criminal activity. Fifth, government accountants. They handle the money of the government, budgeting, tracking spending, and following special public sector rules that are different from business accounting. Sixth, nonprofit accountants. They work with charities and other nonprofits, making sure donations and funds are managed according to nonprofit rules. Seventh, international accountants. These accountants help businesses that operate in multiple countries follow different rules and regulations across borders. And finally, auditors. They are the inspectors. Their job is to check whether the accounting records are accurate and follow the proper rules. So, whether it's filing taxes, keeping score, advising managers, investigating fraud, managing public funds, handling donations, navigating global rules, or checking compliance, there's an accountant for every need. Which accounting jobs will change with blockchain? The whole point of accounting is to give information that people can use to make decisions. But here's the key: if the information isn't trusted, it's useless. That's why ethics are so important in accounting. Ethics simply means knowing the difference between right and wrong and choosing to do what's right. In accounting, this means being honest, accurate, and fair when reporting numbers. Think about it. If a business lies about its profits, investors, employees, and even customers could all make bad decisions. But when accountants follow ethical standards, the information can be trusted, and that trust is what keeps the system working. So, accounting isn't just about numbers, it's also about trust, honesty, and responsibility. Now that we talked about ethics, it's a good time to bring up the fraud issue. Fraud doesn't just happen by accident. Usually, three things must come together. And this is what we call the fraud triangle. The first side is opportunity. This means the person sees a chance to commit fraud without getting caught. For example, weak internal controls, or being the only one handling cash. The second side is pressure. There's usually some kind of stress or need pushing the person, maybe unpaid bills, debt, or even pressure to meet unrealistic work targets. The third side is rationalization. This is how the person justifies the fraud in their mind. They might think, I'm just borrowing the money, or I deserve this because I'm underpaid. When all three sides come together, opportunity, pressure, and rationalization, the risk of fraud goes way up. So, if we want to reduce fraud, we need to break this triangle by limiting opportunities, reducing pressures, and challenging rationalizations. Now, tell me, how do you think new technologies limit fraud? Let's talk about GAAP, Generally Accepted Accounting Principles. Think of GAAP as the rule book for accounting. It provides the general framework that tells us what information goes into financial statements and how that information should be prepared and presented. Where does GAAP come from? It's built on a mix of tradition, experience, and official rules set by regulators. In other words, it's shaped by both practice and authority. And here's something important: GAAP is not carved in stone. Just like sports rules can change over time to make the game fairer, accounting rules can also change as business and society change. Accounting is really a story. It begins with its purpose to provide useful and trusted information. Then we saw the process: identifying, recording, and communicating financial events. That information is used by both internal users like managers and employees and external users like investors and lenders. Next, we met the many professions in accounting, from tax experts and auditors to forensic accountants and those who serve governments and nonprofits. But all of this only works if there is trust. That's why ethics are at the heart of accounting. Without ethics, fraud can creep in through opportunity, pressure, and rationalization. Here we see the foundation of GAAP, Generally Accepted Accounting Principles. Think of GAAP like a building. The pillars holding it up are the principles: measurement, full disclosure, revenue recognition, and expense recognition. These are the key rules that guide how financial statements are prepared. The foundation of the building rests on assumptions. We assume the business will keep operating. Well, that's the going concern. We measure everything in money. That's the monetary unit. We split time into periods like months or years, and we treat the business as separate from the owner's personal finances. Finally, at the base, we have the constraints. These are the limits, reminding us that while accounting aims to provide useful information, we only do so when the benefits outweigh the costs. So, GAAP is not just random rules, it's a carefully built framework with principles, assumptions, and constraints all working together to make financial reporting consistent, fair, and useful. Let's go through the four main accounting principles in very simple terms. First, the measurement principle, also called the cost principle. This means we record things at their actual cost, what we really paid for them. That way, the numbers are objective and not guesses. Second, the revenue recognition principle. We record revenue when we actually provide goods or services to the customer and for the amount we expect to receive. So, if you sell lemonade for $10, you record the $10 when the lemonade is sold, not before. Third, the expense recognition principle, or matching principle. This says we record expenses in the same period as the revenue they help generate. For example, if you spent $4 on lemons and sugar to make lemonade, and you sold that lemonade today, you record both the $10 revenue and the $4 expense today, so the profit is clear. Fourth, the full disclosure principle. This means the company must share all important details that could affect decisions. These details often appear in the notes to the financial statements, so users understand the full picture. Accounting is based on some basic assumptions, like ground rules. First, the going concern assumption. We assume the business will keep operating into the future, not shut down tomorrow. Second, the monetary unit assumption. Everything is measured in money. We don't record things like employee happiness, only amounts in dollars, pesos, or another currency. Third, the time period assumption. We can break a company's life into chunks of time, like months, quarters, or years, so we can report results regularly. Fourth, the business entity assumption. We keep the business's finances separate from the owner's personal finances or from other businesses. Accounting also has constraints, which means limits or boundaries on what we report. First, the cost-benefit constraint. We only provide information if the benefit of sharing it is greater than the cost of producing it. In other words, don't spend $1,000 to report something that only gives $10 worth of value. Second, the materiality constraint. We only report information if it's important enough to affect decisions. Small things that don't matter to decision makers can be left out. Sometimes two more ideas are included. Conservatism. When in doubt, play it safe and avoid overstating assets or income. Industry practices. Some industries have special reporting rules based on their unique needs. So in short, accounting constraints remind us to be practical, focused, and careful when reporting information. So now we will talk about the different types of accounts